right, welcome to OK Computer. I am Dan Nathan. I am joined by a very special guest, a podcast extraordinaire. His name would be Guy Adami. He is my co-host on the tape. He is my co-host on Market Call, both risk reversal media properties. He's also the original member of CNBC's Fast Money. That if we make it until when, Guy, January, it'll be how long?
If we make it until January, it's 17 years. Is podcast? It's like is it now a verb?
Yeah,
you're like
yeah.
A podcast together.
Yeah, like you're googling
so
something
noun and a verb.
Yeah.
Okay, no, look, yeah. I get it.
And who would have thought a guy who's never listened to a single podcast in his life has probably co-hosted hundreds of podcasts. How about
insanity.
That?
It's insanity.
Well, Guy, I have a great conversation with Trevor Marshall that's going to come on right after this. Trevor is the CTO and co-founder of Current, a fine sponsor of this program, OK Computer. We're going to talk about SBF's FTX trial. How about that? That starts today as we are recording this. We're also going to cover some stuff going on in fintech land and just hit tech in general. But I wanted you on right now because you and I, it's funny. I don't think you would consider yourself a techophile or anything of the like, but you've been commenting on technology on the sectors, on individual stocks, on CNBC, on our pods for a very long time. And there's something interesting going on in the markets right now, at least in the public markets, Guy. It seems like, and we've been talking about this on all our pods for a while, and at certain points, it becomes more evident that, there's been this flight to quality, if you will. The S&P has sold off a little more than 8% from its recent highs. It really seemed to start during Q2 earnings period after some of the biggest companies guided. If you recall, Microsoft had to disappoint, at least the reaction by the stock. Apple did to their Q2 earnings a little bit. But right now, it seems like that these mega cap tech stocks, even though they're well off their highs, are seeing money flow into them at a time where, there seems to be some trepidation in other parts of the market. If you look at banks, if you look at, staples, cyclicals, industrials, transports, there's a whole bunch of areas that are acting pretty weak, but money seems to be flowing into the tech stocks. Talk to me a little bit about, from your perch, what you think that dynamic is all about. Also at a time where interest rates, the 10-year U.S. Treasury yield is raging. It's above 4.7%. It has not been here since November of 2007, Guy.
Interest rates are the story without question. And on the tape and Market Call, we've discussed what we thought was going to happen to interest rates and some of the other factors around U.S. rates. But to answer your question, I think part of the reason you're seeing this, again, flight to perceived quality in the form of the names you mentioned is the fact that their balance sheets are pristine. And theoretically, they shouldn't be as impacted by higher rates as some of these other companies. So I understand the knee-jerk reaction, and that would be fine, I think, if valuations for some of these companies weren't as stretched as they are. The problem, of course, is, there's some valuation problems as well. So that flight to quality is what's happened with a lot of these names. It's created a bit of an expensive on a number of different valuation metrics for a lot of these names, which I think at some point is going to be problematic. I think as this plays out, a broader market sell-off, again, perceived flight to quality. I think the last rung of this, the last sort of shoe to drop is going to be, the fall in a lot of these big cap, high growth names that we talk about all the time.
Yeah, it's a great point that you make with interest rates where they are right now. When some of these mega cap tech stocks had these huge cash balances, right, and interest rates were really low, there were a lot of investors, a lot of analysts, a lot of strategists who said this is like a drag. Like the fact that they have all this cash, they're not earning anything on it. The only thing they could do is really kind of buy back their stock, which was good, I guess, if you're taking some shares off the market there, and so when you calculate price to earnings. But right now, a lot of these companies, when rates were really low, refinanced a lot of their debt, and now they're earning 5% on those cash balances. And I think that is part of the kind of flight to quality argument. Now, Guy, the point that you make about valuations on these mega cap tech stocks. There are some that trade at very high multiples relative to many of their peers, relative to their own historical valuations. But then there's some like Meta and Google, the Alphabet and stuff like that trade, at basically a market multiple, right? So I guess we really want to focus on is Microsoft and Apple, which are combined $5.5 trillion in market cap that trade at, high, 20s sort of PEs. And you could say, all right, that's kind of expensive there. So I get all that. Last night on CNBC's Fast Money on Monday, you and I had a conversation with Mary Ann Bartels. She's, I think, Sanctuary Wealth or so. And she made the point that, valuation is not a great market timing tool. Speak to that a little bit. And she also said that she thought that these mega cap tech stocks were about to go into this some super cycle or something, and I didn't really take to much of that. I don't when strategists start talking about super cycles that are about to emerge, I'm usually fading that call. Your thoughts on that and valuation as a timing tool?
Well, I agree with her in terms of a timing tool. Valuation is not a great one. And think about it. We've talked about it for years in a zero interest rate environment. And we have actually said it, and Jerome Powell said it as well. Valuations don't really matter at all. And I know that's somewhat glib, but it happens to be true. Valuations only start to matter as rates start to go higher. In terms of using them as a timing tool, there's got to just be one arrow in your quiver. So if it's the only thing you're looking at, you're not going to be successful. But if you look at valuation and overlay it with maybe some stochastics and some other technical indicators, then things start to make a lot more sense. You would have sold Apple on valuation, on its way up 30 different times and would have been incorrect. But at a certain point, that pendulum's going to swing. And I think it swings in a couple of ways, in the form of a broader market sell-off, which we're seeing, and the form of rates going higher, which we're seeing. And then obviously the last part of the puzzle is, people sort of fleeing the stock market, which we're starting to see sort of around the edges.
Yeah. There's an article in Yahoo Finance this morning that caught my eye for a couple different reasons. One, because our good friend, EY from SoFi, that would be Liz Young, who's the head market strategist over at SoFi, was quoted in the article. But the article is big tech takes a backseat after the AI hype cycle. And, you and I were talking about this in mid-July when we had all of these, major tech companies like Microsoft and Salesforce and Adobe and a handful of others announce some of their pricing of their AI tools, which a lot of Wall Street investors and analysts were really excited about. It was kind of justifying, hopefully, the moves that the stocks had had in anticipation of some of the pricing, so they could start modeling this out. And so the article talks about how we're on the other side of that. And again, we just highlighted the fact that many of these stocks are down, 10% or so from those levels. And it was the peak in the NASDAQ here. Liz's point, and this is really talking about valuation also, said she thinks that the shift to smaller cap stocks could be underway. Now, granted, we've talked with Liz on Market Call on the tape, how poorly the small cap stocks trade. But she doesn't see the next leg higher for the S&P 500 on the imminent horizon. Valuations for big tech and the broader S&P still have further to fall. She believes that before a slowdown kicks off a new business cycle with a new roster of names posting the biggest gains. So she's also making the point that some of the prior leadership might not be the leadership coming out of whatever correction that we have. Talk to us a little bit about that, because on the broader market front, Guy, banks act horrible, right? Some industrials act horrible. Transports act horrible. There's a lot of sectors that are not perceived, like that normally you would like kind of associate with a new market cycle, possibly new leadership. And they're not suggesting that by any means right now. If anything, they're pricing in a recession at the moment.
Yes, she's probably going to be spot on. Of course, the problem for new leadership with what we've created is, 8 to 10 of these stocks now represent, and you've done the math yourself, probably 50% of some of these broader indices. So if you're not going to get the leadership from those names, it's by definition, just by math, it's going to be very hard for the broader market to continue this sort of upward trajectory. So if these generals start to fall by the wayside, regardless of sort of what happens in banks or industrials or energy or healthcare, it's virtually impossible for the market to see the move to the upside of the magnitude that we've seen. So that's listen, on the way up, it's a wonderful thing. Nobody's talking about this because it doesn't matter. Market's going higher. Everything's great. Valuations don't matter. Everybody's happy. But on the way down, when things start to kick in and then you lose that leadership, You can get strength out of a number of different sectors, but if you're not going to get it for those 7, again, to 10 names, that's going to really pose a bit of a problem.
Yeah, Goldman had a note out yesterday. That was October 2nd. Goldman sees earnings-led rally in big tech stocks after Rout. I wouldn't call this exactly a rout. It's not even a correction yet.
Not at all.
In the NASDAQ 100, but they're basically saying U.S. technology stocks may be about to turn the corner after the NASDAQ 100's biggest monthly decline. That was in September, according to strategists at Goldman Sachs. They say the sell-off has historically cheap valuations for tech stocks at a time when earnings estimates are still rising. They point to a valuation metric known as the PEG ratio, PE to growth. Goldman analysis shows that the largest 7 tech stocks have a PEG ratio of 1.3 compared with a 1.9 for the medium S&P 500 stock. So what's interesting about this data here is that it's relative to growth, right? Like that's the whole idea. And if you think about it, like all the growth expectations are in these big 7 stocks. So if they were to slow down, you know what I mean? You're going to see that PEG go lower and it's going to look cheap relative to its historical. But to me, that doesn't paint a picture that I want to go buy these stocks right now, hoping for an inflection at a time where lots of the leading economic indicators are pointing that we're like 18 consecutive months of negative or declines in the leading economic indicators. And you just said it a few minutes ago, Guy. This will be the last battle fought among these generals. We know we started this year with some big headcount reductions there, right? And we're seeing other sorts of cuts and trying to kind of hold on to the margins that these companies have. But if some of the excitement around all of this AI tools don't materialize into revenues and the costs associated with the compute for a lot of these weighs on margins, these stocks, I think what you would kind of guess, they're going to go lower. I mean, like that's what Liz was saying, I guess, in that Yahoo Finance article also.
Margins are so important, listen, for all companies, but specifically this sector. And you didn't even bring up, and you bring it up a lot, and you're correct too, the potential. Well, forget about the potential. The flat out double or triple ordering that's been going on in the stockpiling of inventories that has not manifested itself in terms of earnings yet. But it's just a matter of time before you start to read about it and you have companies start to identify that. And what does that lead to? It leads to margin compression, which theoretically should lead to revenue declines and stock declines, which I think, again, we're on the precipice of, especially when you start to consider the lag effect of all this Fed stuff. It's all lining up effectively at the same time. I mean, it's a confluence of events like we probably haven't seen in decades. So that's why I'm negative. Now, with that said, I've been this way for a while and it hasn't played out. It's just starting to show itself around the edges. But, you know this and I know this. When it happens extraordinarily quickly. And we talk about this. The market takes the stairs up and the elevator down. And, all that passive money on the way in is great when stocks are going higher. And a name like Apple, which is in close to 350 different ETFs, of which Apple is a top 1, 5, 15 holding. It's great when that passive money flows in, but when that stops or, God forbid, becomes active, that's when things get problematic.
Yeah, well, there's been some areas where like investors have been active, and like you think about the semiconductor index that the SOX is up more than 40% of the year. I think a big part of that obviously is Nvidia up 200%. Now it's 20% of the SMH, the ETF that tracks the semiconductor index. The second largest holding is Taiwan Semiconductor, which you've often said is probably one of the most 5 most important companies in the world, and this has a $450 billion market cap, and the stock is down 22%, Guy, from its June highs, from the 52-week highs. And so when you talk about this sort of double ordering, you talk about the chip bans that, we have, you talk about the geopolitical situation between China and Taiwan, but why is this stock down 22%? If you think about all those things should kind of make, orders look great over there. And so maybe investors are starting to discount what you're suggesting, again, about some of the double, triple ordering. We might end up with some large inventories. We know there's been crazy demand for some of these high-end graphics chips that train these large language models and generative AI models. And so if we were to not see the commercialization of some of these products, you might see a push out. There was also an article that Deirdre and I talked about last week in the information, talking about how Microsoft obviously largest investor in OpenAI. They've been integrating their, large language model GPT-4 into search, into their productivity tools and the like. And again, they're talking about actually going down a parallel path, creating their own large language model that actually takes much less compute. So meaning like a lot less expensive, Guy, to operate, right? Because if they don't have the commercialization, they need to have some products that actually won't weigh on margins as much. And so I just thought that was really interesting, and that could signal a push out of some of the demand for some of these high-end graphics chips that are very expensive to run.
Listen, 100%. And now I'll put my technical, analysis hat on. And you talk about Microsoft, which is a remarkable company. And I've said this and I believe it. I think it's one of the 5 or 7 most important companies in the world. And they've positioned themselves that way. But look at where we recently topped out in the stock. I think it was in July, when we probably traded close to, 365 or so. And then go back and look where we topped out in December of 2021. Not coincidentally, by the way, a lot of stocks did. You have a textbook double top. Now, again, folks listening to OK Computer are probably not laser focused on that. But it's important to point out, as we're sitting here right now, Microsoft's within a couple dollars of a multi-month low and hasn't traded particularly well for the last few months. Again, great company. You have to start questioning its valuation. And if you look at the last couple quarters, by Microsoft standards, they have not been particularly good. So that's a bit of a problem when, again, you're talking about a company that has a market cap of $2.3 trillion.
Yeah, to your point, this thing is in correction mode. And again, talking about the charts, Apple, Microsoft, they all broke those uptrends that have been in place from, early this year, the lows, the QQQ, the NASDAQ 100 is about to do the same or has to some degree. And so you're seeing some of the generals kind of, roll over technically. And that's one of the reasons why I think this NVIDIA is so important. When they report, and again, they're not going to report in October, it's a late cycle report, but, this stock, gapped to about 400 on that ridiculous guidance that they gave. And granted, it was up, 70%, and it was well above expectations. And, the guidance that they gave the next quarter, and, in August, the stock traded above 500 briefly, but reversed a little bit. So here we are, we're trading at like 440. The stock traded as low a couple of weeks ago. It was like 410 or so. That was $100. That was a 25% rout off of those intraday highs following that guidance. This is why this stock is so important. If you see this stock below 400, you're likely to see, this is in the next couple of months, a NASDAQ that's in far more than correction mode, maybe even, getting close to down 20% from its recent highs. Well, listen, Guy, I just wanted to, kind of check in with you a little bit from a sentiment standpoint, because again, we spend a lot of time focused on these, large, 7, 10 names or whatever. They're really holding up not only just the NASDAQ, because they make up 50% of the NASDAQ 100, but they also make up 25% of the S&P 500. And so to me and you, we think they're going to be the last battle fought with this market. But when you look under the hood at other areas away from technology, things are not great in the stock market, reminding you and me both a lot of late 2021, where we're scratching our heads and everything we looked at under the hood, other than the largest names in the market, wasn't great. And that led to a bear market of at least a year.
As we're sitting here, Bank of America is making a 52-week low, effectively making a multi-year low. Bank of America, not an insignificant bank by any stretch. You're talking about a $200 billion company, and then throw on top of that a Citibank, for example, and 2 of the larger banks in the world are showing some problems around the edges. And then you throw in the regional banks, which all had huge runs in the spring. They're starting to give it back now. One has to wonder what this interest rate's going to do to a lot of those names. And, we're not here just to be dour for the sake of being dour. We're just here to point out some of the obvious things that nobody seems to want to talk about.
Well, I appreciate you coming here and talking about it on OK Computer. That's Guy Adami. You can catch him with me on Mondays and Fridays on the tape and Market Call Monday through Friday at 1 p.m. Eastern. Go to our Risk Reversal Media page. That's where that streams live. Obviously, go to your podcast store to check out On the Tape with Danny Moses, Guy, and myself, and Liz Young on Mondays. Stick around for my conversation with Trevor Marshall, CTO, co-founder of Current. All right, welcome back to OK Computer. I am with Trevor Marshall. He's the CTO and co-founder and my landlord of Current here. So this is where Risk Reversal Media, we do all of our podcasting in your fine home here in New York City and Chelsea. welcome back.
Yeah, thank you for having me back.
I mean, thank you for having us. But all right, listen, you and I have a lot to talk about. This is Tuesday afternoon. It is October 3rd, and there's a few trials going on here on the island of Manhattan. One where I was up actually on Fifth Avenue in the 50s near Trump Tower, and there are literally people out there with like their MAGA flags, like waving them around, like to support him in this civil trial. I think that's kind of interesting. You won't find any flags down at the SBF FTX fraud trial here. Now, this is something that I have to assume, because you've been in, and we've talked about this on the pod, many times, like you've been in the crypto world for a while. You know a lot of the players doing lots of different things. Let's just take a step back here and just put some context to the sort of fraud that existed here. This guy was the golden boy. FTX was like, we had Tom Brady, hawking their wares on TV and the like here. And the fact that this thing has come crashing down, I do think it's kind of interesting. Like, what does this mean for folks like you who have been really closely associated to this market? You've been participating in the market. You've built a company with some parts of the ethos of the crypto world here. What does this mean? Is this like going to bookend some of the worst behavior that we've seen over the last 5 or 6 years? I'm just like, is this something you're going to track very closely?
Yeah, I mean, I'm definitely following like the trial and all that, just because it's very interesting, relevant to the industry, and it has a big impact, honestly, in things like investor confidence and just the overall desire to kind of work more in the space. When it's not just about the technology, it's actually about the businesses that are formed around the technology, because I can approach it from both angles.
Would you say for every massive fraud like this, there's 100 or 1,000 very legitimate companies working in and around the edges of this industry?
I don't know about 1,000, but there's a lot. There's a lot.
There's dozens.
There's dozens, right? I mean, I think the defense that is reported on that he's going with, which is sort of like I've been advised. The advice of my lawyers was that everything was okay. Yeah. I think what it's more about is, and from the beginning, from the sort of the day he got arrested, I've been saying, like, I don't think this was some grand mastermind plan. I think this was just a tremendous amount of sort of incompetence, and then probably covering up some lies and having that spiral into something crazy. Because
is that giving him the sort of benefit of the doubt? Because there's some folks in and around the industry, some very high profile people. I mean, Bill Ackman, not that he's in the industry, who's the billionaire hedge fund guy, runs Pershing Square, activist. He's well known for causing lots of trouble with fairly legitimate and maybe some illegitimate companies. But the fact that he came out, I think, quickly in defense of him on Twitter, this was a few months ago or something like that. It's just kind of odd. It seems like, and then one of the criticisms about Michael Lewis, who wrote this book that's coming out also in some of the earlier reviews, is that, again, they're giving him some of the benefit of the doubt a little bit, like maybe just a mad genius who was pushing the edges, here and there.
I definitely wouldn't give him the genius credit either. I think it's on both sides. I think the sort of greatness or whatever, it was certainly there was good ideas in the sense of people needed access to liquidity. Yeah. But I didn't see a grand design in either direction, malevolent or sort of like this genius.
But
status.
You don't think it's so what I think is really interesting about this whole thing, if we want to bookend when Bitcoin came into being, it was during the financial crisis. And if you remember, as the financial crisis was unfolding, this Bernie Madoff scam was being revealed. And this was a multi-billion-dollar Ponzi scheme. And so it's kind of interesting that, Bitcoin was created to, create censorship resistance and, all these sorts of things. I don't need to tell you what it was created for, but it really was in the wake of the financial crisis. And here we are on the other side of that, and we have something that looks very similar, like a massive Ponzi.
Yeah, I mean, but it wasn't using any of the true crypto. There was no reserve proof. Right. There was none of the things that you would expect. And then there was also sort of this fallacy of, oh, well, we have these reserves. They're FTT tokens. They're these sort of things that do trade, but maybe trade $100,000 a day. And oh, by the way, we've got 4 billion of them, $4 billion worth. So I mean, there's certain market fallacies that got encoded. Similar market fallacies happened with Luna and the mechanics for this automated hedging of a stable coin, which of course, issued trillions and made that thing disappear. And look, I was sort of lucky to see a little bit behind the curtain with FTX in particular.
Do tell. Let's see. It sounds like you got some story. Michael Lewis, give us a ring here.
I definitely, I got to experience what they were working, and it was a very chaotic startup. a very chaotic place with just not a lot of control over what they were trying to do. And that was because, they're getting a ton of money, getting a ton of most likely pressure to go and grow, certainly a lot of pressure to actually open up shop within the US legitimately, which for them meant getting a bit license. And they were just not really able to do that. They didn't have the caliber of staff or focus to be able to do that. They're doing this all with a few hundred people at most.
Isn't it amazing though? Kate Rooney, a very fine reporter at CNBC who covers the fintech space and crypto, and she's got a digital documentary out about this whole thing. It's on CNBC.com. She was on Fast Money with us last night. We're talking about some of this, and they had a clip from a guy that maybe some think is reputable, some not, but Anthony Scaramucci, who runs Salt or Skybridge, and he was an investor, and he was a very early backer, I think, or I don't know if he was an early backer, but he was a very prominent backer of SBF. And in this doc that Kate details, I mean, he obviously did an about face, and he basically talked to what you're saying is that it was just a very chaotic situation.
Yeah.
They did not seem to have a handle on things. So do you think we'll learn anything that makes the industry stronger that comes out of this suit? Like, are there some benefits that are going to come out if it's done properly and they throw the book at him? Because it sounds like his ex-partner, both personal and professional, has turned state witness, and she's got all the goods in her seats.
Yeah, the whole thing is just chaos, right? I mean, he's got tons of witnesses against him.
Yeah.
He's got
any prominent defenders or no?
Not that I know of. But again, it's definitely there was definitely crimes committed. Yeah, no doubt. I don't think it goes to this level of conspiracy that some are assigning to it.
Well, and listen, and that'll be really interesting to see how it bears out. And what do you think it means for the industry right now? Because listen, the proponents right now are not as loud as they were, a few years ago in general. And this was something I think you and I've talked about this before, even in the crypto winter that went on during 18 and 19. A lot of the folks who've been building and investing in the space, they just went heads down and they kept on doing it. And then they had this other period where there was all these different applications for it and the price kept going up, right? And the interest of it, both institutionally and from retail investors continue to increase. If you look where the price of, let's just call it Bitcoin right here, which has a $500 billion, market cap still, after everything that we've been through, it is lower left, upper right. And there's been fits and starts. So I'm just curious, how are you thinking about this now? How are you thinking about it from an investment standpoint? I think you've told me in the past that when you have some of those big disconnects lower, you often add to your position. Do you sell? And I know this is a personal question, but I'm just curious, but then broaden it out. How are you thinking about it holistically? Because you've been involved since almost the beginning, at least a decade. Does this sort of stuff kind of shake any of your conviction on it?
It definitely enforces some of the convictions that I've had for a long time regarding actually on-chain DeFi and sort of the mechanics. If you think about how do situations like FTX happen, it's through lack of transparency. And if you're creating a financial ecosystem around transparency, it doesn't have to mean that it destroys privacy, but there are ways of at least guaranteeing that certain things happened. So I think we talked a little bit last time about Lightning and just payment channels and just more efficient ways of doing things with Bitcoin, or more efficient ways of there's continued build out in a whole bunch of other sort of ecosystems that are still interesting, that push the financial application actually on chain and to be something more transparent, which I've been saying for many years is the interesting thing ever since Compound in 2020 got really popular, and a lot of those DeFi protocols got really popular. Same thing with NFTs, even though that the prices on most of them have completely gone away just because they were very much hype driven.
So our crypto dick butts aren't worth anything anymore?
Hey, I still get bids on that on OpenSea. Yeah.
Okay, fair enough.
It's an active market. No, they the concept behind them and the what those things are on their own still holds up.
What's interesting? So I don't know if you follow abc.com. That's Fred Wilson of Union Square Ventures, he was a very, very early, I think he was like the first institutional money in Coinbase, and they made an absolute killing when on the exit. And he's been in Helium. He's been, they have been in a whole host of projects. He still blogs every once in a while. And he had a post, I want to say a week or so ago, about a scam. I mean, he got scammed. I mean, here's a guy who's made gazillions in crypto, and he's done it personally. He's done it, through USV. He's probably, really early on hundreds of NFTs, and I think you can see all this sort of stuff. He got scammed out of some NFTs just recently, and he details it, and it's called The Heist, the post on abc.com. So, I mean, check it out. What does that mean to you when people like him, who are as savvy as he is, who gets the business, they understand the risks and that sort of thing, are still getting scammed? And you could say, well, listen, people get scammed out of dollars, they get scammed out of stuff all over the place. Is that your answer?
Honestly, that is sort of the take, which is social engineering and other types of scams have become, especially through COVID, just way more sophisticated, way more prominent. The amount of data that you can find on any individual identity with like a credit card and knowing where to go to what websites to go to, it's pretty it's wild. And there's just this reality, especially in the US, that like there isn't really strong identity. Social security numbers are all pretty much leaked.
But people really don't care about it, right? Isn't that kind of it, or no?
Well, they care about it when they get scammed, and people are using the amount of data that's available to make those social engineering attempts way more credible. So if I can call you up and I can tell you what I think the last four numbers of your credit card are, that's a extremely credible thing. How did you know that? Or if I could give you some other sort of personal information that
admit to making phone calls?
Phone calls in this day and age?
Yeah, what is that? So I get all that. So there's just a lot more information about all of us, and
it's the mechanism for the theft, right? Yeah. Like the fully digital value is just easier to scam because I don't need to be in front of you with a gun to take it from you. I mean, that's probably one other mechanism you could use, but digital money is way easier to steal.
Yeah. Well, all right. So money, for the most part, is all digital now. It just depends what form it takes. And I do think that there was a headline, I think a week or so ago, that JPMorgan Chase in the UK, as of I think in a couple of weeks, is going to ban payments, on their rails, right, using crypto. Like, what does that mean to you? That seems like so 2018, 2019 a little bit.
That's what it feels like to me. I don't think many people will follow them, especially in the UK. The UK has always been really good about, it's your money, you do what you want, everything from sort of betting to crypto.
But it's about scams. I mean, like they're basically trying to protect their customer. Like at least that's what they're suggesting.
I mean, look, to go quickly back to the scams, like if you compromise an account and let's say pay someone else money out of your account, in the US, there's regulatory protection for that. Under Reg E, you can open a dispute against that, and there's claims. And there's just not really the same framework in place for a lot of what's happening in crypto. But a lot of them still, like if you want to, for example, add money to a crypto account that's going down through a debit card or a credit card, those have dispute liability and controls around them. So I'm not totally sure the direction. I think they're trying to make a statement. They're not doing anything that will destroy the ecosystem. With those actions, there's I think plenty of ways around what they're trying to do as well. Just like if you're at that bank, but we'll see if anyone else follows. It's unclear to me what the purpose is.
All right, so this brings me to another story. This is something I read in Axios, and we'll put this Felix Salmon in the show notes. Why the U.S. needs a better instant payment system, and it's talking about Varo Bank, which is, it seems like it's a competitor to Zelle, and the article highlights that Zelle, while it works really well, it's fast and free. Neobanks like Current are not able to participate, or at least the customers on those platforms. Like it seems as a consumer, we have all this stuff coming at us, but none of it is interoperable. You know what I mean? And again, this is like away from, let's say crypto altogether, but like even, all our money is digital, and we all want it to be fast and free, and it should be. Like, what's going on here? And are we, again, in the U.S., it seems like we are further behind some other parts of the world on this.
Yeah, well, I think this one in particular, like, the private markets are stepping in. This is a Visa product effectively. And Visa has been trying to push this forward for a long time, and it's something that we're partnering with them on as well on a few other initiatives. But generally card-to-card payments as a replacement to bank-to-bank payments, which is something that is available in the EU and the UK through like open banking regulations. There's not really the same need, even in Canada. you can get money from one person to another very easily. It's kind of a solved
even
problem.
in Canada for our Canadian listeners here. I'm sorry. I mean, you can say even in Canada about a lot of things. I know, but
even in Canada, you can get healthcare. But I mean,
they have
like
universal healthcare.
A country that's like 1/5 the size, and certainly like 1/20th or 1/30th the number of financial institutions, and maybe that's the reason why. You're able to get sort of instant payments from person to person. And so in the US, that gap is getting filled by large private companies, which is like how so much of banking in the US works anyway.
Yeah. Hey, I want to put my fast money hat on. That would be my CNBC fast money hat on a little bit and talk about some of the areas I think of your expertise and how at least the public markets are kind of interpreting this. It was kind of interesting, like some of these lending models, like in a firm, the buy now, pay later, they were left for dead. I think that stock was down 90% from its highs. It saw this tremendous pull forward in adoption of those sorts of services, during the pandemic, especially at a time where people weren't out and about and doing things or whatever. They were thinking about things they could buy, and they just, I'll just spread them out, the payments and that sort of thing. But it seemed, that thing came crashing down. And maybe that's not a good example. This is not like a profitable company, but there are things on like the PayPal and in Square or Block and then Zoom. These were like three pandemic darlings in the stock market. I think they were up hundreds of percent each. And, at one point, PayPal had a greater market cap than Bank of America. All three of these companies are very profitable. Okay, the three that I just mentioned, not a firm by any means. And I'm just curious, when I think about how these stocks are trading, we have a NASDAQ that is up, let's call it 30% on the year. This was after being down 30% last year. And we know many of the components last year were down multiples of what the index was down. Okay, but these stocks can't get out of their own way. Like the three that I just mentioned, they are left for dead. They're all down at least 80% from their 2021 highs. What do you think is going on? Let's just focus on maybe PayPal and Square a little bit. What do you think is that the investment community, whether they be institutions or retail, are not seeing with these models? Maybe it has to do with their behavior. Maybe it has to do with competition. I'm just curious, like thoughts on this, because I know that you keep an eye on the public markets also.
Yeah, no, absolutely. I think for those two in particular, there's been a good amount of leadership change. PayPal is like the big one with Jen stepping down, and even at Square, there's their CEOs turning over. And if you look, post-pandemic to pre-pandemic, we're around the same levels stock-wise.
Yeah.
So I think there's definitely something to be said of like, well, when you put too much air into the system, like it's going to have trouble getting it back after it releases it. And so there's I see a lot of the price action now as being mostly like either technical or like over trading. Like we're sort of in the voting machine, not the weighting machine, weighing machine mode for these stocks in particular. But I think the bigger underlying question that investors are having is, what does the growth really look like? And I think we talked a little last time, but are they going to be able to expand the use case? Are they going to be able to expand monetization on a per user basis? It's not totally trivial to do that. In financial services, that will either come through an increase in the sort of payments relevance. So for me, that is like, does PayPal get really more aggressive into consumer checkout? Does Square really crack their distribution of merchants and thinking about how to tie that back to Cash App, like really closing that payments loop? Or are they going to be making a successful move into credit, which at a time where you've got now a lot of small banks across the US reporting multi-year high delinquencies on credit, that could be a dicey thing for them to like. It
was like kind of like Zillow getting the house flipping market at the top.
Yeah. Well, PayPal, they got like buy now, pay later. So does Square.
Yep.
But I think the opportunities around much bigger lines of credit are still out of reach.
All right, so let me play stock market for a second. Okay, so PayPal now has a $63 billion market cap, okay? And the company now is expected to have, let's say, mid-teens earnings growth next year on high single digits revenue growth. Gross margins are like expected to be 47%. That's down from a 90% margin in 2021. And you would tell me, because that was just, the way the transactions that were going on their platform and the adoption of it, it was just really profitable. More competition, it slowed down. But, PayPal has a good balance sheet, expected 47% or so gross margins. It's trading at 10 times earnings, a little less than 2 times sales. You know what I mean? Like, to me, that just seems cheap. And I just bring this up because it reminds me, let's say, of 20 years ago, 2003, this is the year or two after the dot-com implosion. And there were plenty of companies that were the poster children of that period. Their stocks were down 80, 90%. I mean, Amazon famously was down 85%. The NASDAQ now was also down 80% from its highs. And I'm just wondering, what the hell's wrong with this? There's new management there. You said there's at some point you have to assume that they're going to figure some stuff out, and it trades way too cheap.
Yeah, honestly, I think that's where the weighing machine takes over.
Yeah,
right. I think it is a matter of time. I think people are still sort of sitting on the sidelines, feeling burned from both private market and public market competitors. That whole sector of financial technology has been challenging for many folks.
It's interesting. It almost feels like from my standpoint, there needs to be some sort of a capitulation, and then you just kind of hold your nose and buy a name like that or something like that. Well, listen, we covered a lot of ground. I really wanted to hit the SBF stuff because I do think it's interesting, and it's interesting to see who is going to come out and maybe be slightly sympathetic to this sort of situation. It seems like you think that, this was just a really, really poorly run operation, pushing the edges, and at a time where regulation was pretty uncertain and that sort of thing. But there was a lot of scammy behavior
and harm was caused.
Yeah, harm was caused. No, I'm not suggesting that you're not, like you don't feel that way. And the payment stuff, I just find fascinating. I just think that this is a behavior that more and more people are just embedded into their financial lives here, digital payments. And it just seems to be, whether it's on chain or off chain, it seems like we're going in that direction. It just depends how familiar you are with those sorts of products and what sort of, I guess there's a difficulty. Wouldn't you agree? Like for a Fred Wilson to be scammed on his iPhone or whatever, I think he's an Android guy, you know what I mean? Whatever he's using on apps that he's pretty familiar with, that sort of thing. It does make you wonder where the normies, how they're operating and how frequently they're getting owned on this.
I just know that being a scammer is something that Gen Z can even aspire to. There's so much on TikTok, and there's a ton of content for how to rip people off.
The kids today.
So it's going to get worse before it gets better.
All right. Trevor Marshall, CTO and co-founder of Current. Thanks for joining me on OK Computer.
Thank you.